Hi everyone, it's Nancy Godrad. I'm going to go over part of Chapter 2 in this video. The learning objectives for Chapter 2 are distinguishing between merchandising, manufacturing, and service companies. We're going to go over some cost behavior patterns and use a method to estimate the variable and fixed portions of a mixed cost. So the first thing we want to talk about is what is the difference between merchandising organizations versus manufacturing and service companies. First of all, the main difference is their source of revenue. In a merchandising and manufacturing organization, they sell finished goods. Now, a merchandising company will purchase the finished goods either from a wholesaler or a manufacturing company, whereas a manufacturing company has to make the finished goods from scratch and then sell it either directly to customers or to wholesalers and retailers, or a combination of all. Service companies, the main source of their revenue is providing services, so they don't have any inventory. Unlike merchandising and manufacturing companies that do have inventory. Now, the way we calculate their net income, if you were talking about a merchandising or manufacturing company, because they sell inventory, one of the expenses you're going to see in their income statement is cost of goods sold, which is basically the cost of those items they're selling. What was the cost to the company itself? And then from their sales revenue, we're going to reduce the sales revenue by cost of goods sold, and sales revenue is selling their merchandise, and the difference is gross profit or gross margin, which is an accounting calculation that is watched carefully by internal and external users of income statement. After that, we reduce gross profit by operating expenses, and the result is operating income or operating profit. When we're looking at the service company's income statement, you will see that there is no cost of goods sold because they don't have inventory to sell. Their main source of revenue is providing services, so the name of the revenue is called service revenue instead of sales revenue compared to merchandising and manufacturing companies. Therefore, you won't see a gross profit calculation. The difference between the service revenue and operating expenses is their operating income or operating profit. Now, the balance sheet for merchandising and manufacturing and service companies, the main difference between income statement is the fact that one of the main differences is the fact that a service company does not have an asset called inventory, whereas merchandising and manufacturing companies do have inventory. In this slide, they're trying to show you how to put together an income statement for a retailer, which is a merchandising company, and you will see that the income statement always will have a heading, which is the name of the company, the name of the statement, the report, which in this case is income statement, and the period it covers. And the period normally starts, it covers a specific period of time, a beginning and the end. For this company, it's for the year ended December 31st, 2017. Again, we start with sales revenue and then reduce it by cost of goods sold. And the difference between 150K and 60K is called gross profit. The other name for gross profit that is used interchangeably is gross margin. Operating expenses are listed below gross profit, and the difference between gross profit and total operating expenses is their operating income. Now, if the company doesn't have any non-operating activities such as interest income, interest expense, that are not related to daily operation, then if that's not the case for the company, operating income and net income would be the same. Okay, so now in order to calculate cost of goods sold for a merchandising company, we need to know this type of information: their inventory when they started the period, how much inventory was sitting in their store or warehouses, and their ending inventory, what they haven't sold at the end of the period, and the purchases of inventory that they made during the period. What we do is we put it into this formula: beginning merchandise inventory plus purchases minus ending inventory is cost of goods sold. Beginning inventory plus purchases is called cost of goods available for sale. Basically, what the company has available during this period of time to sell minus what they haven't sold gives you a calculation of what has been sold, cost of goods sold. Now, in a merchandising company, in order to calculate cost of goods sold, instead of using purchases, we need to calculate cost of goods. In a manufacturing company, instead of using purchases to calculate cost of goods sold, we need to calculate cost of goods manufactured to calculate cost of goods sold, because a manufacturing firm actually produces the inventory they sell. So the formula, it's a little different to calculate cost of goods sold. Instead of purchases, we're going to look at cost of goods manufactured added to beginning inventory minus ending inventory. That gives you cost of goods sold. Now, this chapter goes over how to calculate cost of goods manufactured for a manufacturing company. So let's go over that. These are the formulas for calculating cost of goods sold for a manufacturing company versus a merchandising company, and I've already gone over that for you. Now, in a manufacturing company, in order to produce a product, we have three costs, which we call a manufacturing cost or product cost. The three costs are direct material, or we for short write it by DM, direct labor or DL, and manufacturing overhead, MOH. What is the definition of these three product cost or manufacturing cost? Direct material is a subcategory of raw materials. Raw materials are basically any materials and parts that we need to use in manufacturing the product. So for example, let's say we want to manufacture chocolate chip cookies. One of the material that you need, raw material that you need, is chocolate chip. And of course, sugar, oil, and rest of the stuff. Now, the material, raw material, can be divided into two categories. Direct material, those are the material that you can physically and directly see in the finished product or associate within the finished products, and their cost is substantial. Indirect materials are those materials that you do not physically see or become part of the finished product, or their cost is so immaterial, meaning it's not substantial enough to keep track of it in a separate as part of direct material. For example, let's say you want to bake cookies. You need to spray the pan with oil, or and that oil eventually will evaporate. In order to prevent from the cookies sticking to the cookie sheet, you kind of grease it with the oil spray. So that oil spray is an example of indirect material, because it is the amount of it, the cost of it is not substantial enough to consider it direct material. So we call it indirect material in manufacturing accounting, and that indirect material is put into a separate category called manufacturing overhead. Remember the pre-product cost, direct material. Now, indirect material goes into the third category of manufacturing overhead. What is manufacturing overhead? Manufacturing overhead are the cost of running the factory except for direct material and direct labor. So any factory related costs that are not direct material or direct labor falls into this third category or third bucket called manufacturing overhead. We'll go over a couple of examples. Now let's go over labor. Again, for accounting purposes, calculating manufacturing companies' cost of product, we divide labor into two subcategories. Direct labor is the work of those employees that work directly with the end product. So people who are in the assembly line assembling the product are considered direct labor. So any wages or salaries we pay to the assembly line workers are considered direct labor. And any other person who does not directly work with the end product, but we need their services in the factory, we are considered those costs indirect labor. For example, the cost of the custodian or the janitor that is cleaning the factory, or the supervisor that supervises the process, or the employees, the wages or salaries of those employees are considered indirect labor. Indirect labor again becomes part of manufacturing overhead. So as I mentioned, manufacturing overhead are costs that are indirectly associated with manufacturing the finished product. We need to spend money in the factory to produce the end product. However, any costs such as electricity, such as the depreciation on the machinery that we have in the factory manager salaries, factory supplies used, and factory insurance policy, indirect material, indirect labor are considered manufacturing overhead. Now, you understand after this session that you need to remember the three product costs for the rest of managerial accounting: and direct material, direct labor, manufacturing overhead. Now, once you add the direct material used, direct labor used during the period to manufacturing overhead used, you have the total current period manufacturing cost. If we add it to the beginning working process and reduce that amount by ending working process, the result is cost of goods manufactured. And look at this section of the slide that tells you how to arrive at direct material used in the production. I will discuss the rest of it in a separate video. Talk to you soon.